What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 31st of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's Macro Monday, we're going to be talking about what may very well be the biggest macro event we have for both crypto and equities into the close of 2022, and that is the upcoming Federal Reserve FOMC meeting that's going to be happening this Wednesday on November 2nd. And it is going to be the moment where we get to hear from Jerome Powell whether or not all of the hopes and rumors of a potential Fed pivot are going to come real, or if we are going to see the Fed continuing on its current aggressive trajectory in order to properly tame inflation. Now, again, you all know what my thoughts are here, and while we are going to be diving through the charts, I want to go ahead and just try to set the foundation for what we can expect, what I personally think the Federal Reserve is going to do, and talk about something that not only the headlines, but the majority of market experts are really ignoring, that I think has a major weight in whether or not the Federal Reserve is going to do the right thing and tame inflation here in the short term. Now, while I usually would dive into the price action here right away, I want to go ahead and spend a little bit of time to just talk about what we know about this FOMC meeting, so we have a ground foundation of what to expect. The first thing that I want to get out of the way here that really isn't up for debate to any large degree, as the majority of prediction markets, market experts, and economists are clear in understanding this from the Fed's comments, that they are going to raise rates by 75 basis points here in this upcoming FOMC meeting. It is a very, very low probability that that is not going to happen. The Federal Reserve has been very clear about this, that they are on pace to do that increase to 75 basis points. However, there are really two things that are sitting up in the air here that I think we need to talk a little bit about. One of them is the more popular discussion points, and that's whether or not the Federal Reserve is going to potentially hint in this meeting that during the next FOMC meeting, where they'll make their next policy decision, whether or not they're going to consider lowering their increases to only 50 basis points or 25 basis points versus the typical 75 basis points we've been going at, which is one of the most aggressive rate hike paths that the Fed has ever taken throughout its history. And it's jacked up mortgage rates, it's jacked up the cost of credit and capital in the economy in order to try to cool down demand and the excess credit. But this also leads us towards a second question, which I want to bring up a little bit later on, which I think is really going to be the determining factor here that markets are going to be watching. They're not so much just worried about the federal funds rate. That is definitely an important dynamic here. And I think, generally speaking, if the Federal Reserve is going to do the right thing here, and if it really is serious about dealing with inflation and softening the blow here, having really a soft landing, ironically enough, people usually say that the Federal Reserve would need to pivot in order to cause a soft landing. I think that if the Federal Reserve is right about tackling inflation, really surprises markets and gets more aggressive and tightens here in the short term, they can make the pain much softer here. It's going to be a sharp downturn in the medium term, but in the long run, it's going to be great because inflation will have been dealt with, right? Now, I know a lot of people have different perspectives on this, and if you've been reading the headlines, you've probably seen all different types of perspectives. You've seen more hawkish headlines here that say that the Federal Reserve is going to continue on its trajectory here, not only in this meeting, but even further into the next few months, as well as potentially articles that talk about the inflationary measures that we've seen as of recent that can give us hints to what the Federal Reserve is going to do. And you also might see less hawkish headlines, ones that say that the Federal Reserve is going to have to backtrack and potentially start lowering its hikes to something more like 50 basis points or 25 basis points and maintain rates at a neutral range, right? All different types of opinions out there. But let's just go ahead and really try to understand what needs to happen here. If the Federal Reserve wants to tame inflation, we need to understand where we stand right now and where the policy decisions are at right now that match those results. Now, if we take a look at the U.S. PCE price index, okay? This is one of the major inflation metrics that we have at our disposal that the Federal Reserve has stated very clearly is one of their target indicators, and on an annualized basis, their goal is to continue hiking, continuing to keep monetary policy in a hawkish state in order to get the PCE and other metrics like it down to their target of 2%, okay? So when we take a look here, right, we right now, on an annualized basis, are sitting at 6.2% on the PCE. It's a very important dynamic to keep in mind. We have been at this range since as far back here as March of this year. We've basically been pushing sideways here, starting to form the top out of inflation. And this is a great first step here. This is a great first thing to see here because the Federal Reserve is doing the thing that it needs to do. It is tightening. It needs to tighten monetary policy. When we look back over the past year and really the last decade for that matter, with the expansion of the balance sheet from the Federal Reserve, with the neutrality of keeping rates at 0% with no trend to the upside, we need to understand that all that excess liquidity is now coming into the system. And if the Fed doesn't reverse sharply against what it's done for the last decade and get aggressive and ahead of inflation, this metric will continue climbing up. And if you don't believe me, take a look not at the year-over-year metrics, but the month-over-month metrics. Many people thinking that we should start seeing deflation, we should start seeing the cost of goods and services declining. We are not seeing that here, folks. Last month in September, the reading we just got here for October is at the same level we had back in the previous month, at 0.5% month over month. Now, I think many of you would agree here that in order to really start seeing a substantial decline, to get us down to that 2% target, we would need to have more tightening here. We need to get to a point where we are starting to see month-over-month declines in the PCE, at least at the final stages before the Fed would consider a pivot. Or, at a minimum, we need to get down to 0% here month-over-month, so that month by month, that annual figure is getting back down 2%. I'm really getting artistic with my hands here and illustrating this, but you get my point, right? I basically just want to emphasize that while we have completed stage one, which is keeping inflation at bay rather than accelerating into an uncontrollable range of territory, we are starting to see it flatline. But we need to see step number two, which is a substantial month-over-month decline in the rate of growth of inflation. Now, with this upcoming meeting here on the 2nd, the big thing that I've got on my mind here is that the Federal Reserve is going to continue its trajectory. It needs to continue shocking the market here, continuously surprising people. If we get this other additional 75 basis point hike, or at least we get hints that it's coming, I think the market is going to take a harsh rejection to the downside, because a lot of people have been buying the dip, hoping on the last decade's promise that the Federal Reserve will always pivot, always come to the rescue, but they don't understand the dynamics of inflation and how the Federal Reserve finally realizes, looking back in the 1970s from the previous wave of inflation, that they've got to get ahead of the curve. And as you can see here, it is clear within market price action that we are on the verge of a rebound here, a rally in stocks, albeit I think it'd be short term if it happens, or a continued breakdown here as the Nasdaq is now trading below its 200-week moving average for the first time. It is sustaining below there and right now treating it as resistance, at least in the short term, for the first time throughout the entire secular bull run we had over the last decade. And it's starting to look a lot like what we saw back in 2008 or here during the dot-com bubble. But again, some people are pointing towards some of the more positive indexes. Some people are looking at the S&P 500, which got a very nice boon here, over 8.8% month over month here in October against the 200-week moving average, similar to previous dips in the past. People are looking at the Dow Jones, 14.4% here in the past month. A super mega rally here in the big names, mainly led by strong plays like Apple and other defensive stocks in the energy sector that have been doing very well with the way oil prices are, right? So again, as we emphasized, you can look at any of these charts and give different narratives. Someone could look at natural gas and say, hey, you know, with the warmer expected winter that's coming here in Europe, energy prices aren't going to be so crazy. There's not going to be such demand as we previously thought. And that's going to play a role in waning down the energy cost in Europe. While we've got cheaper natural gas prices down to where we were back in July, and there is some clear signs we might be topping here, it's also important to take a look at oil, which again has been maintaining neutral from where it was back in summer and is starting to form higher lows here and potentially a pair of higher highs, right? We can look at all these different charts. I could point to you taking a look here at the month over month chart here, right, for the US 30-year yield, which again, with this signaling higher moves, this means that the Federal Reserve is going to continue tightening, continuing increasing interest rates and dumping US Treasuries on the market. And we could also take a look at the Dixie. People could provide different perspectives that we've got lower highs and lower lows. Some may say this is a bull flag. What's my point here? All right. I think that the market here is focusing too much on interest rates. And we have seen that very clearly as it does play a pivotal role in a lot of market metrics. And it is going to have a weight on where things go. I think the answer of what the Federal Reserve is going to do next and what the Fed needs to do and what we need to watch for and what they say in this next FOMC meeting is the direction of where they take quantitative tightening, not when it comes to just the federal funds rate. That's one part of the puzzle. But I think the biggest one that people aren't talking about is the balance sheet. It's kind of interesting, right? How during the last decade, the balance sheet and quantitative easing, when we think about QE as a term, we talk about that balance sheet, right? We talk about all that green being printed, right? The month-over-month printing of new money into the system. That really, in my opinion, is the biggest reason why we've got the inflation and the supply and demand dynamics that we have right now in the economy. And I'm going to go ahead and showcase why that is. Last month, for the month here in October, we wrote a letter for the Dash Report members. And one of the biggest focus points that we talked about was the expansion of the mortgage rate here. Now, this is the highest mortgage rate. You guys have heard me talk about it here on the channel. We try to cover, a good equal amount of topics here on the channel. I don't want to leave you guys in the dark or anything. But we've talked a lot over the past couple of weeks and months about how the mortgage rates have accelerated. The cost to borrow to buy a home has accelerated as the Federal Reserve has been increasing the federal funds rate during the FOMC meetings. And this is the highest rate it has been to basically buy a home, to borrow money to buy a home in over 20 years. And that is, bear in mind, at record housing prices, far beyond anything we have seen in the past few decades. All right? Think about how good the times have been to be a homeowner over the past decade, or to go out and take a mortgage at 2, 3, 4% and be able to just buy up properties, turn them into rentals and Airbnbs. That whole bubble is going to slowly come to an end. I'll talk a little bit about why that is, because the Fed realizes it's not just going to use its tool here of increasing the federal funds rate and therefore jacking up mortgage rates. They are cutting down the consumer side demand, really like the everyday consumer looking to just simply buy a home for their family, right? They have already stunted that demand, and mortgage applications are rightfully starting to decline here as the mortgage rate is going up, right? It will definitely need to go at a more aggressive pace, but that's one part of the equation. If we take a look at home prices, though, what's really interesting is that even though we've been getting this mortgage rate increase, many of you might know that, hey, my rent is still going up. Hey, housing prices are still way out of reach here. Even if mortgage rates were low, I don't think I'd have the money to go out and buy one. What's going on here? Well, what's going on here at the moment is that there's still way too much money in the system, way too much cash. And it has to do with this chart right here. The Federal Reserve balance sheet, the United States Central Bank balance sheet, still sitting at a whopping $8.7 trillion, well beyond where it was back in, say, 2008 at around $880 billion. We have created an enormous foundation for the base monetary supply. And the credit and excess money built on top of that doesn't get accounted for in the balance sheet, really into the broader money supply, it is beyond recognition, beyond what many people really perceive it is. It is so big, so exacerbated, that we've basically, over the last decade, made it pretty attainable to be a millionaire in that case. I think that's a visual way I always try to explain it to people. Let's be completely honest, guys. Not everyone is a quote-unquote millionaire. And we've seen that as the market valuations in both the bond market and in the stock market and crypto have come into correction. And as we've started to see this play out into fruition, we know now that we are in a tightening period, and that a lot of this excess liquidity that has made people think that they're as wealthy as they are, unfortunately, is going to lead them right back into a reality check. We are about to go through a wave of tightening. If the Fed really wants to get serious about cooling inflation, it's got to take at least one of these three paths. And that is either reducing the secondary wave here of the balance sheet expansion during COVID. They either need to get down to reducing half of that balance sheet, or if they really are serious about tightening the excess here, reversing us back to their trajectory back during the early half of the decade, getting us back down to about $4 trillion on the balance sheet. What that is going to mean for the available liquidity to buy stocks or crypto, which is usually bought up with discretionary spending, money that people can afford to lose outside of their normal costs, it is going to cripple these markets, folks. And now, I don't think, to be honest, I think we all know better in this case that the Fed will likely not pursue this path unless they really need to. But either of these two more realistic paths for the balance sheet and what the Fed chooses to do here in these next few meetings, how swiftly they can get down to these targets here. I just kind of put them out here on the chart. But again, all right, this is following the current trajectory. Either way, we've got to see what the Federal Reserve is going to do. If it is smart and in the short term starts aggressively reducing its balance sheet, dumping mortgage-backed securities, dumping U.S. Treasuries, we can start to tame inflation substantially in the economy. We can start to get to a point where we are going to cool the excess money supply, because if we can reduce that excess money supply, we need to understand here what the Federal Reserve is doing. If they're dumping mortgage-backed securities and they're dumping U.S. Treasuries, that is going to take capital away from investing in property. That's going to drag down housing prices. It's going to remove a lot of that excess liquidity, and that's going to allow for pricing to cool, not only for housing in order to buy one, but also for rents. And on top of that, it's going to bring asset prices down to cheaper valuations, which is going to support more money, discretionary money, going into investments, again, rather than spending it in the real economy. That's exactly what the Federal Reserve needs to do now. They need to make assets more attractive. They need to take money outside of being spent in the economy. And they need to cool down consumer confidence even more than they already have at the moment. Those are all the kind of dynamics and factors here. This removal of the excess money and credit in the system is exactly what's going to bring us back to supply and demand equilibrium. And it's going to buy the time for the real physical economy and its issues of supply chain issues, housing inventory, all the things that have really exacerbated the inflation that we've experienced to start to come back into equilibrium with that demand. It's going to buy the time that we need. The Federal Reserve is going to do the right thing here in order to get us down to those levels. That's the key thing we need to watch for here. Will the Fed do the right thing and reduce its balance sheet? It's one thing to tighten rates or to go up by 50 basis points or 75 basis points. Those 25 basis point moves, those variations, do have big impacts. But if the Federal Reserve stops its current trajectory of reducing its balance sheet and doesn't actually, more specifically, if it doesn't get more aggressive here, we are going to have inflation for a long period of time. You can bet on it here. You've got all this excess money you're competing with here that's starting to spend that money in the economy, who's starting to spend that on housing prices, to buy up dips, right? Until they get rid of that money and start absorbing it somewhere else, stocks, crypto, you name it, it's not going to get better. Inflation isn't going to get better. It's really difficult to kind of get a visual perception of all of this because there are so many different macro dynamics at play. But when we come back to the conversation of Bitcoin here, I know we haven't talked about much about Bitcoin here, but I want to emphasize one thing. I know a lot of people here in the short term have gotten real excited about the fact we cleared through the descending line of resistance. But there are a few things that I want to emphasize. You've got on Bookmap here, our really exciting partner tool here on the channel that tracks the market order flow, goes a bit deeper than just analyzing price. We can see it's abundantly clear that while price moved up here, there is still capitulation. People are still net sellers rather than net buyers here for the market. That is true here on Multibook, their proprietary tool that allows you to see the market order flow across all the exchanges and the order books. And it's very clear here as well when we take a look at the most liquid derivatives market, the Binance futures, a negative CVD of over 6,000 points here, completely reducing a lot of that buy side pressure that drove up price in the first place. We're only getting bid side support, and that is not what drives bull markets. What drives bull markets are those initial 10 to 20% candles to the upside that signal it's time to go long. The bear market's over, right? We are not seeing that yet. And we are about to see something that for the first time in history has happened, which is the 200-day moving averages crossing the 200-week moving averages. You can zoom out on Bitcoin's chart. It is the first time we have seen this here. Every time the 200-day moving average would slowly cup up right above and start moving higher above that weekly moving average because it used to be a buy the dip opportunity. Nowadays, Bitcoin has been trending below the 200-week moving average since back in June. That is a screaming sign of fear. We've never seen this throughout Bitcoin's history, having it remain below that moving average for so long. And I think that is indicative that the market is starting to realize, especially in the most risk-on assets, that the Federal Reserve is much more likely to continue tightening, not just on interest rates, but also on its balance sheet if it wants to tame inflation. Again, it is up to the Fed, and the Fed has pivoted and changed from time to time throughout its history. It has said one thing and done another many times throughout history. But something's different here. Time and time again, like during bull markets where the Fed would always pivot, during the past year, the Fed has made it very clear that it will continue to tighten and tighten and tighten, even against the experts and the market experts out there who are calling for a pivot, who again might have been very respectful and the people who are winning out in the last bull market, but will be the losers and the people who are wrong time and time again during a bear market. I think we need a bit more shock and awe before we really see the end of this correction period. But if you can be patient and wait for those proper opportunities, you will get dip buying opportunities or a clear trend sign, a clear reversal back to the upside that are going to be all the signs you need to start going long in the market and taking risk once again. Anyways, that's it for today's video, guys. I wanted to say two quick things. If you like this video, consider dropping a like. And on top of that as well, if you guys haven't already, consider checking out our newsletter here on the channel, the Dash Report. You guys can save 20% with a yearly membership. If you like these type of topics where I kind of zoom out of just the crypto space and really cover the macro perspective of what's going on, then the newsletter is perfect for you guys. Essentially covers crypto, stocks, Forex markets, commodities. I do recommend, if you guys want, you guys can go ahead and set a reminder. If you're interested in subscribing, set a reminder for tomorrow, as we will be dropping the new newsletter tomorrow. If you guys want to get the new edition, if you like the kind of content we covered here, we're going to be talking about what's going on and the technology companies. It's going to be a really interesting article where we share our thoughts and perspectives on it. But you get so much more than the newsletter. You also will get trade alerts. You're going to get market updates that are exclusive for the Dash Report group, all kinds of really cool stuff. So if you guys are interested, check out the link down below in the description. Go to nicholasmerton.com/Dash Report and sign up today. It's a great way to support the channel. But even if you can't do that, again, dropping a like is a great way to support the channel, guys. And until the next video, I'll see you all in the next one. Take care, everyone.